One of the most impressive earnings reports that I have seen after the first quarter of 2025 is On Holding. This is a company that makes consumer goods. They should be highly impacted by tariffs, but the company's reaction to the potential impact of tariffs is to say, you know what? We have pricing power. We can actually raise prices on our already high-end products. So I want to go through exactly how impressive the company's growth is, just phenomenal growth in the quarter, and then raised guidance for the full year. And the market obviously liked the reaction with the stock up about 12% in trading on Tuesday. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's go through all of the results that you need to know from this earnings report. Now, the one thing I want to note is this is reported in Swiss francs, CHF. So this is not in US dollars. I will report some constant currency numbers. But if there's some kind of strange numbers in here, that's typically why. I'll get to some of the impacts on the income statement in particular. But you can see that sales increased 43% in the quarter, 40% on a constant currency basis. Now, a couple of years ago, On said that they expected long-term growth to be about 26% on a compound annual basis over the next 3 years. The company is absolutely crushing that, and that's expected to continue for the rest of the year. Direct to consumer is really where a lot of the strength is coming from, 45.3% growth there. 42.4 on a constant currency basis. Wholesale, which is basically selling through other retailers, still really solid at 38.6% on a constant currency basis. And then the other thing to look at is where the growth is happening. So you have Europe, Middle East, and Africa is 33.6% growth. The Americas, primarily the US, is their biggest market that grew 32.7%. And then the huge growth number came out of Asia Pacific that was up 131%. If this growth rate continues, this could be the company's biggest market in the next 4 or 5 years. And then the other piece that I've been talking about for a while with On is they have a lot of optionality to grow outside of shoes. Shoes was a big growth driver, 40.5% growth. That alone would be phenomenal results, but they did also have apparel and accessories both growing in excess of 90%. Those are relatively small businesses today. But if you can grow those businesses at 90, 100% per year and compound that for a few years, suddenly you got a really sizable business. I think that's potentially where On is heading outside of the shoe market. The other thing that On said is they are maintaining their really, really high margins, near 60% margins for gross profit. And that also resulted in a higher adjusted EBITDA margin from 15.2% to 16.5% in the quarter. And outlook, while a lot of companies are getting a little bit more conservative about what they're expecting for the rest of 2025, On said 28% net sales growth on a constant currency basis. That was up from about 26%, like I said. Now, that's much lower than the growth that they had in the first quarter. So you would potentially expect their revenue growth rate to slow down the rest of the year. I think management is kind of sandbagging those numbers here. And you get that indication from the conference call. They don't want to raise this expectation too high and then come back later in the year and just say, you know what, just kidding. Instead of 33% growth, we're only going to grow at 28%. So they want to ratchet up those expectations for the year, but maybe don't push them too high just in case something happens with tariffs or a lot of things that are out of their control. Now, the other thing I mentioned is that foreign currencies play a pretty strange role in On's results. That's because they have a lot of cash in the US. And so this number right here, the foreign exchange gain or loss, can be pretty significant for their results. You can see that a year ago, that was a gain of 76.8 million francs. This quarter, it was a loss of 14.5 million. That's likely going to continue into the second quarter because the dollar is getting weaker. That's making those dollars look smaller when you're looking at it through a lens of the Swiss franc, which is where these numbers are reported. So basically what that is doing on the income statement is just trying to reconcile how much cash is on the balance sheet. If the cash value in the US stays the same, but the value of the dollar goes down, you have to adjust that on the balance sheet. That's where this number is going to go down a little bit, and that's going to be resulted in the loss that we saw on the income statement. But really solid balance sheet, and for a company growing this quickly, it's very hard for a consumer goods company to be able to build the inventory they need to grow at 40% and remain profitable, remain cash flow positive, and long-term On Holding is doing that, in part because they have pricing power. And this is where the company's conference call, I think, was really interesting. And you can see that in this comment right here from Martin Hoffman. So we are in position to increase prices, and we will do this. There's a lot of context that they put around this, but basically On is a premium brand, and they want to maintain that premium brand. So if tariffs are going to increase the costs of other shoes in the market, let's say you're looking at a Nike shoe, and that Nike shoe it suddenly has its cost increase from $100 to $120. Now it's maybe a little bit more on par with an On shoe. On doesn't want to be sitting next to Nike at the same price point. They want to be at a little bit higher price point. They want to exude that premium by being at a premium price point. That is what they're going to do, is actually increase their prices. They've said that they've already done this on a couple of products and more products that's going to be coming down the pipeline in 2025.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
So what's the reaction to tariffs? There's companies are going to have different reactions. There was companies that are saying, here's the financial impact. We're not going to be able to raise prices, but we're going to actually have to eat these because we don't have the ability to pass these costs on to customers. On is saying, you know what? We're not going to have a huge impact from tariffs, but where we do have an impact, we're going to more than offset that by actually increasing our prices. So I thought that was really interesting. Then you have their spray-on shoe as well. That's another thing that I think could be really interesting for them long-term. That is actually moving a lot of the production basically to where the shoe is being sold. So, and this is their light spray technology. They're starting to test this, sold a few of those in Switzerland in the quarter, but that is likely to roll out over the next year or two. They're basically just going to be importing the sole, and then the rest of the shoe is sprayed on in basically a custom manner depending on what somebody is buying. That right now, that shoe is about $300. Could see that being something that goes into mass production, even at a slightly lower price point, and still maintain that 60% margin or so. So when you look at this whole earnings report and you look at how On is sitting in the shoe and fashion segment in consumer goods, I think this is one of the companies that is strongest right now. They're serving a market that has the money to spend on a higher end shoe, on a more premium product. You're not seeing sales slow down. In fact, you're seeing sales accelerate. That 40% growth rate, 40+% growth rate is really a sign that the On brand is commanding a lot more attention from consumers. I think that is going to continue no matter what happens with tariffs or even the economy. So this is a phenomenal growth stock, and it's not crazy valued right now. As I'm recording, enterprise value to sales is about 6.5. Price to earnings multiple is a little under 60. They're not really optimized for earnings at this point. You can't optimize for earnings when you're growing at this rate. So that's not surprising that it's all that high. It's actually a little bit more surprising that On is profitable, growing at 40+%. And then on a forward basis, the enterprise value to sales is just 5.2. Price to earnings multiple is about 44. You compare that to other companies that are growing much, much more slowly, and I think On starts to look pretty attractive as an investment. I would love to see a little bit of a pullback because we are now near the 52-week high, but this is a stock I am absolutely not selling. It's a pretty significant portion of my asymmetric portfolio. So happy to be holding it because it's been a phenomenal performer, and their pricing power and what they said that they're going to do with prices over the next year is really another sign that they are in a very strong position. But let me know what you think about On holding today. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.